why do investors sometimes fail to achieve adequate returns from their investments? I come across people, they invest their money, they don't diversify, they invest a substantial amount into one or two funds, and these funds most commonly are funds which are designed to give 6 or 7% return on a yearly basis in a good market. In a favorable market, you might end up making 7 or 8% return, but when the market goes down, our funds will go to negative territory. So now what we suggest our clients to do is, instead of investing your money into funds which are designed to give 6 to 7% return, you need to look at investing your money into high growth funds. Simply keeping your money in a fund or platform which is designed to give you 6 or 7% return on a yearly basis, because in early years market cycles used to occur every 5 to 6 years, but nowadays it is happening in every 2 to 3 years. So when the market goes down, these funds also goes down, and that results in not making enough money for investors. So if our intention is to invest our money and make a decent growth from our investment, we need to consider some key points. One is, before you invest your money, you need to understand where exactly you are investing your money in. For example, you need to do a research and understand what are the trends in the market. For example, if you look at investing in tech, investing in artificial intelligence, investing in semiconductors are going to benefit you in the near future, because these are the areas or sectors which are going to perform in the near future. So we need to understand those sectors and invest in stocks and ETFs which are investing in these sectors. That is one thing. Second point is, you need to understand the market. Normally we say it is difficult to time the market. It is about time in the market. So we say you need to invest your money over a long period of time to get the benefit of compounding. But we don't have to time the market. It is highly impossible to time the market, but we can understand the market towards a certain extent. And when the markets are undervalued, we understand that the markets are undervalued. That's the time to invest your lump sum into market. And when the markets are overpriced, we can understand that the markets are overpriced. At that time, you need to stay away from market, or you need to invest on a regular basis into market. The third point is, you need to be mindful about the charges you are paying for the platform or the fund you are investing your money in. For example, if you are investing in a fund which is generating 7% or 8% return, and it is charging you 2% on a yearly basis, that's not feasible in my opinion. So yeah, for each and everything there is fees associated with it, but that has to be reasonable. So we need to look into that before you invest your money. And the point 4 is, so if your intention is to stay in the market for a short period of time and make gains from the market, I would not suggest you to invest in equity market, because markets will fluctuate short term and you might end up losing money. Fifth and the most important point, if you are investing your money and if you are generating 8 or 9% return on a yearly basis, you need to consider that S&P 500 has given 14.5% return on a yearly basis for the past 5 years. S&P is considered to be the benchmark of all dollar-based investments. If S&P is giving you 14.5% return, you should get more than that. So do not hesitate to switch the funds if the funds are underperforming. If you are investing your money into an investment plan or into a fund which are designed to give 6 or 7% return, you might get 6 or 7% return in a favorable good market, but when the market goes down, that will negatively impact the performance of your fund. The reason why I say is because in early years, market cycle used to occur once in every 6 to 7 years, but nowadays tend to happen in every 2 to 3 years. We have to actively monitor the market and make investment decisions and switches based on the market conditions. By paying attention to these factors, investors can make returns from the market, because markets are always giving good returns. Even if you take S&P 500, it has given 14.5% return. If you invest into semiconductors, if you invest into tech, artificial intelligence, they are giving more than 20% return from the market. So identifying these sectors and segments in the market and investing in them is going to make a huge difference in our wealth creation journey. Many investors enter the market with high hopes, but most of them fail to achieve adequate returns from the market. There are enough reasons for it. One of the reasons I could understand was they all invest without diversifying their money. They all invest that money into 1 or 2 funds which are designed to give 6 or 7% return in a good market. But when the market goes down, this will negatively impact our fund. So what I suggest our clients to do is, first of all, you need to diversify your money. That is highly important. And you need to always look at the benchmark, S&P 500, which is considered to be the benchmark of all dollar-based investments. When S&P 500 is giving you 14.5% average return in the past 5 years, your investment fund should give you equal to or above 14.5% return. That is very important. So one more thing, in the past, market cycles used to happen once in every 6 to 7 years, but now that tend to happen once in every 2 to 3 years. So understanding the market and stay close to market is highly important. So consider these 5 points before you invest your money.